Hey everyone, welcome to another dividend stock investing video. I want to cover covered call ETFs in the video today. These are very popular with dividend stock investors. These are ETFs that pay very high monthly income, high dividend yields to dividend investors like myself. I own XYLD, which is a covered call ETF on the S&P 500. I've been acquiring this ETF now for about almost 1 year, and honestly, the results of this ETF have been lackluster. It's interesting, one of my subscribers mentioned in the comments that he's really looking forward to this market correction, to this bear market, if you will, because it can really stress test a portfolio. A bear market correction can stress test whether the components of the portfolio can hold up and do what they're supposed to do during tumultuous times. Personally, from personal experience, when I look at XYLD, I am not as excited about it as I was before, and I want to share this message with the dividend stock investing community because there has been over the last year a lot of hype around these covered call ETFs, including XYLD. Another one is QYLD. There are many others as well. And I'll link in the pinned comment below, in the description below, to a few videos that I did a while ago covering these types of investments. But I want to share my personal experience today. I want to share my personal experience, how I've actually, over the course of ownership of XYLD, I have lost money. And that is the last thing that this investment was supposed to do. This is the type of investment that was supposed to hold steady on the equity component and then spin off cash flow that the investor can use for paying bills or for reinvesting or for investing in other stocks. And it did not perform as I was expecting it to perform as far as I've owned it to date. So get ready, everyone. I have a really exciting video in store for all of you today. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to get started with the video today. The first thing I want to do, though, is I want to point you out. Check out the pinned comment below. I have a link to my personal Patreon. Over on Patreon, I have 2 tiers, and on the corner Patreon tier, I am sharing updates on my complete dividend stock portfolio. I just uploaded a brand new update. This includes the percentage allocation to all 55 positions in my portfolio. And when I was uploading that recent portfolio update, that's when I was really looking at XYLD. And I had the idea for this video today because I looked at it. It's a smaller position in my portfolio, but it's one that a lot of members of the community talk about. XYLD, QYLD, these covered call ETFs, they're talked about all the time as being dependable. They're talked about all the time as providing cash flow on a monthly basis. They're talked about all the time as providing high levels of dividend yield. And so I personally got very intrigued with this investment about a year ago for all of these reasons. And I thought now is the perfect time from real life experience that I can share with all of you how it has performed. And so I want to kind of go in reverse order today. I'm going to start out with the performance I've had on this investment, and then I'm going to go through some other ideas, some concepts on this investment. So check it out on the screen in front of you right now. The first thing that I just want to share is my history and results with XYLD. So what this is, it's a covered call ETF. What they do is they purchase the S&P 500 and then they write covered calls against it. Those covered calls are supposed to drive tremendous cash flow options premiums that are then distributed to the shareholders in this ETF, this exchange traded fund. And over long periods of time, one of the reasons investors like XYLD so much is the underlying equity tends to retain its value while spinning off cash flow. But in the real world, I haven't seen that so far over the last year. So first thing I want to do is just share my shares. When did I purchase them? I purchased the bulk of the shares that I'm using for my analysis today between August of 2021 and November of 2021. My average purchase price of XYLD is $49.87. And for the longest time, XYLD was trading in this range. This range basically of $49 to $50, and that's exactly as you would expect it to do. That's exactly as an investor would hope that this type of investment would do, that it would retain a very consistent share price, because the point of this type of investment, it's not to have huge capital appreciation. It's actually to store intermediate term cash and earn a nice yield on that cash. And so for the longest time, it was doing what it was supposed to do. Its share price would fluctuate between, say, $49 and $50, and that's where I kept buying it. And month in and month out, it would pay off steady cash flow. But as you can see on the screen in front of you right now, you can see that this thing has fallen in share price. What you can see right now is just a stock chart that I wanted to share. And you can see it was very steady for a long amount of time, but then all of a sudden with the market correction, it is correcting in share price with the rest of the market. And so the first thing that investors should note is that during this market correction, this most recent market correction, the underlying value of the equity, it is falling in price. Now that is not so surprising, because you can also see in the chart on the screen that in prior corrections it has corrected in price as well. Time will tell if it recovers as it has in the past. I think out of all of the covered call ETFs, this is the one that tends to perform the best over very long periods of time. But I want to keep going. So as you can see the statistics in front of you on the screen right now, where is it trading? It's trading right now at 44.36. So I am down 11.1% on this investment. And we're going to get into some comparables in a minute, but it's interesting that this particular investment honestly is performing pretty poorly as compared even just to the S&P 500, which is the underlying index in which it's writing covered calls against. But we'll get there in a minute. First, I want to get through just some more statistics on my personal investment. So far in distributions that come through monthly from this company, I have earned 6.56% yield. Now, that yield is, mind you, ordinary income. This is not qualified dividends, so it's taxed at a higher rate. Now, if the current rates of distribution hold up, I expect to kind of close my first year of holding this with about 8.55% in ordinary income yield, thereabouts. Now, if I go ahead and I look at the amount I'm down on the equity, which is 11.1%, and I subtract out the yield that I received, and I'm not even considering tax implications here. If I take 11.1 and I subtract out 8.55%, I am actually down 2.51%. So more or less, over the course of owning this thing for a year. Now, this isn't a perfect science because I bought this thing in multiple tranches. If I actually looked just as if I bought it all on 11/21 and looked at that year, it would, year forward from there, maybe it would perform a little bit better. But I'm just looking at from the August purchase, when I first started purchasing it, through projected August of 2022, I'm down about 2.51%. Maybe the gap gets closer to 0%, again, if I look at it November through November. But I'm being realistic here, practical. I'm kind of looking at a practical case because most investors are like me. They're not just buying this lump sum, set it and forget it. They're averaging in. Most of the people I see out there on Twitter who are talking about covered call ETFs, they're not just buying it one and done. They're averaging in like I am. So I'm just trying to look realistically over the course of owning it for 1 year. How has it performed from the first time that I bought it? And you can see that it's trending down in equity, and that equity trend down, that drawdown, is surpassing the ordinary income that's coming through. Even on the conservative XYLD, which is on the S&P 500, it's a lot more conservative than QYLD, for example. Let's keep going. As you can see in front of you right now, the next thing that I want to share is I did add a new tranche of this thing, surprisingly, as recent as April. I actually, in April this year, 2022, I deployed more money into XYLD at 49.25. And you can see again, it kept holding up, holding up, holding up, even through April, where the market did start correcting. This was on April 22nd. The market had already started correcting and it held up. It was still at 49.25. Now that's a little bit lower than my average purchase of 49.87, but it's in the range that I would have expected this thing to be. I would expect the underlying share price, the ETF price, the equity, more or less to be in a range, even in a bad market, say, 48, 49 to 51, kind of that range. Now, worth noting, the amount of money that I deployed on 422, it was a larger sum of money. It was 71.2% of all of the money I deployed into XYLD was in April. And so I'm not including that, though, in this analysis because I haven't even started receiving yield on that yet. Very soon here I will, but it hasn't kicked through just yet. And so what I'm actually have a conclusion here, but I'm kind of going in reverse order in the video today. And I will get to some of the other assets, the comparable assets in a minute, but I thought I'd start in reverse order so that you could just see how it's performing. My conclusion is I could have done better in almost all other assets that I'm going to mention in the video today, other than perhaps just owning the NASDAQ, and I'm not really a NASDAQ investor. Yes, I own some tech stocks but that are included in the NASDAQ and other stocks that are included in the NASDAQ, but in general, most other benchmarks, at least how I'm looking at this, have performed better than XYLD over the last year from a practical experience. And so what I'm not doing at this time, I'm not really adding more to XYLD. I'm not getting too negative on it because this has been a volatile stock market, and even when I bought XYLD, I noticed that in the downturn during the pandemic, for example, this thing took quite a nosedive. And so I have to be fair to it. I have to give it time. I think the other thing worth mentioning that's very important is, what is XYLD? The way I look at it is I look at it as an intermediate term cash alternative. It's kind of like an intermediate term bond in some ways. It's not the same as a stock, for example. It's not the same as holding cash, for example. It's not the same as owning or holding gold, for example. This is a bond-like alternative, and the reason that I hold it is to stash intermediate term cash that I don't need right away, that I may need in the future, and to earn yield on it. Well, what else is kind of a good intermediate term benchmark to look at it? Well, bonds. And we've all known that during this last year, during these last few months, bonds have had some of their worst performance in years. So I'm not talking about the yields, but I'm talking about the prices of bonds, just the value of bonds as they're traded on the markets. They have taken a nosedive. And so if I look at it through that lens, I guess the performance of XYLD is a bit more understandable. And so if I look at it as it's more like in the bond-like component of my portfolio, maybe it's just kind of doing as the rest of the market is doing. And so I have to be fair to it for that reason. But let's keep going. As you can see on the screen in front of you right now, the next thing I want to share on XYLD is if I do ever need capital for dividend stocks, one of my favorite dividend stocks like PepsiCo or Johnson & Johnson goes on sale, I may sell my XYLD and plow it into that opportunity. But for now, I'm just going to let it sit and do its thing. And I think the biggest lesson that I learned out of all of these is these covered call ETFs, they got a lot of hype. They got a lot of hype during good times, and even during good times, it's important to build a portfolio for both good and bad times. And XYLD, it's a great cash alternative, especially in good times. But the jury is still out. In bad times, especially prolonged bad times, if these bad times we're in now continue for a long trajectory of time, I think we really need to analyze XYLD. I'm going to need to keep an eye on it and see, how does it do? How will it do in a prolonged bear market? In general, I'll say I feel that I'm probably better off just focusing on basics. These kind of extraneous ancillary positions like XYLD, are they adding that much value? Is it that much value I'm getting out of this versus just focusing on the tried and true core dividend stocks? I'm not so sure. Now, thankfully, whenever I pursue alternative investments like XYLD, I try to exercise smart asset allocation. My patrons already know this, but XYLD comprises about 0.58% of my portfolio. So it's a much smaller position. By contrast, Johnson & Johnson is at 8.48%, Starbucks is at 6.14%. And so in general, it's important to keep that in mind, that when I do go after these ancillary positions, I'm trying to allocate a smaller amount of money to those ancillary positions. That being said, I've spent quite a bit of time here on my channel talking about XYLD. I've spent quite a bit of time researching this thing. Is it even worth it? Would have I just been better putting that same money in Johnson & Johnson? I think I already know the answer. Probably better off in J&J. And the lesson I would say to me is that during really good times, I've seen this a few times in the last, say, decade, when times are really good and it's hard to find value in core dividend stocks, I've seen myself sometimes, I'll go for something different. I'll go for high growth stocks, or I'll go for high yielding stocks like XYLD. And if I catch myself doing that in the future, what I think is probably a better alternative is just to put the money in cash and then wait for a market correction and put that money into core dividend stocks. Now, in practice, will I end up doing that? I'm not so sure, because the theory is always easier than practice. And as an investor, I always like to carve a percentage of my portfolio for fun investments. And I kind of categorize XYLD into that fun bucket. And I think that's okay as an investor as well. Now, I've gone in reverse order, so I want to go all the way back to the beginning of the video, because I think there's a whole lot of background behind XYLD that is helpful to share with the community. But before I do that, if you're enjoying the video so far, please go ahead and smash the like button. And please go ahead and share in the comments below. Do you own these types of companies? Do you own, or these types of ETFs? Do you invest in ETFs like XYLD, RYLD, QYLD, NUSI, JEPI is another one. These kind of covered call ETFs, this whole basket of investments, do you like those? Are those a solid fit for your portfolio or not? Put in the comments below what you think. And going forward, I'd be curious as well, do you plan to buy any more XYLD or similar types of investments? Share with the community. And also, before we continue, don't forget to subscribe. I have new videos on the way all the time. So check it out on the screen in front of you right now. The next thing I want to share is just the overall background today. And so the number one thing that I wanted to share as a message in the video today is volatile markets can stress test an income-focused portfolio. I am very excited about this bear market because it's causing me, even though I'm 20 plus years into this, rethinking the portfolio, thinking about what makes sense, what doesn't make sense. And the things that we all want to keep an eye on during volatile times, in my humble opinion, is dividends. Are any dividends cut? We want to keep a focus on dividend income. Is it reliably growing? We want to understand during this stress test, one of my subscribers was saying basically he's kicking off FIRE, Financial Independence Retire Early, on dividends right now. And he's excited because he wants to see, well, is this even going to work? Because this is a volatile market. Are the dividends going to get cut, or are they going to pay for my retirement? Is it going to work? Is it not going to work? This is a good time to test all of that out. I think stablecoins, there's been a lot of drama recently around stablecoins, not the stablecoins that I own, but some stablecoins. This UST stablecoin has completely collapsed. And so this is going to be an interesting time during these volatile markets to see, hey, do the types of stablecoins that I own, US Dollar Coin and Gemini Coin, are those going to continue to provide reliable interest while holding their underlying value or not? The bear market is probably going to surface that. Are covered call ETFs viable? That's the one I highlight here because that's the one that I'm discussing in the video today. My long story is I think that the covered call ETFs are somewhat viable, but I just think there's better alternatives out there for investing, at least based on what I've seen over the last year. Now let's keep going. As you can see on the screen in front of you right now, the next thing I want to share is just the background is during strong bull markets, investors can get carried away with riskier options, riskier investment options. And I've seen this in strong bull markets. Sometimes investors can't find value in core dividend stocks. And so it's easy to get carried away with alternative investments like covered call ETFs, options, strategies, NASDAQ type stocks, tech stocks, you name it. And so that's something just to keep in mind if you're someone like that who gets carried away with some riskier investment options during bull markets. It's just a good thing to know. And sometimes what I found, because I am someone who likes to explore different types of investments, I try to carve a smaller percentage of the portfolio for those types of experiments like XYLD. Now, also, I think investors can forget the basics and buy riskier assets. I would say I personally did this with XYLD. That being said, as I mentioned, I like to carve a smaller percentage of the portfolio for these types of tests. And will I ever stop doing that? Realistically, the theory tells me to stop doing it. In practice, I probably will not. And that's why I am able to carve, and I have to carve a smaller percentage of the portfolio for these types of tests. I would say bear markets in general, they can be a fantastic reminder to stay on course. And so now what I want to do is I want to share just a few alternatives to XYLD. Like, how did this thing, we all know how I performed in it now over the last year. I know that it's quite lackluster of performance based on what I was expecting over the first year of ownership. Quite a bit more drawdown, honestly, in a market that, yeah, it drew down, but it didn't draw down that bad. And so let's look, how did it perform compared to some other investments? As you can see in front of you right now, what I did is I personally bought, again, between 821 and 1121 for an average price of 49.87. And so I'm just looking roughly over the last year, how did other investments perform? Well, we all know, and we're all trying to fight against, is the US dollar losing its value. We know the US dollar, if you just held the US dollar, it probably lost about 9.62% of its value based on the CPIU calculation. And we know that because that's what I-bonds are paying right now. And I-bonds are indexed to the CPI. The government is admitting that inflation is at 9.62%. And now those I-bonds will readjust every 6 months. But one possible alternative to XYLD is just I-bonds. And I-bonds are yielding 9.62%. Again, it gets adjusted, but that is, and you can only put in up to $10,000 per year per account, or per tax ID, that is. And so that's one alternative to XYLD that has very little risk. The only risk there is the US government defaulting on that investment. But we know so far, even the US dollar losing 9.62, well, at least $1 is $1, whereas XYLD, now $1 is 98 cents or so, 97 cents. And so we know at least the US dollar is outperforming. We know the I-bond is vastly outperforming. Here's something interesting. We all see how the S&P 500 is dropping quite a bit lately. And that being said, I think it's really important to look at perspective. A lot of people are saying this is a terrible correction. It's a terrible bear market. Personally, I think we could get to a terrible correction or a terrible bear market. It'll take some time and a lot more hikes in the Fed funds interest rate. But so far over the last 1 year, the S&P 500 is down 1%. So if I just look at the last 12 months of time, S&P is down 1%. Clearly, even holding the S&P 500, just an index fund, and holding that, the investor generally would have probably done better than holding this quote-unquote conservative covered call ETF. It seems like this ETF has really gotten slammed during this most recent correction, which honestly isn't even that bad of a correction. And I think the theory where this thing is kind of breaking down a bit is, when I went into it, my investment hypothesis was during volatile times, the options premiums would jump. They would jump quite a bit in the options premiums. Now, the options premiums on the covered call ETF, for the covered calls that they're writing, they seem to be hiking up in recent months, and even comparing year over year, the options premiums are coming in a little bit stronger. And in fact, as you can see on the screen right now, I'm going to toggle back to another screenshot. I did a whole analysis on that as well. If current premiums and volatility hold up, I would say the go forward dividends on XYLD are roughly about 10.6% yield per year, which those still would have lost money because I'm down on the underlying equity 11.1%. And what I would also say is that 10.6 is taxed as ordinary income. So again, it's struggling in some ways just to keep up with the S&P 500, which tells investors something about this type of investment. Let's keep going. As you can see on the screen right now, the next thing I want to share is NASDAQ. Over the last 1 year, the NASDAQ is down 11.69%. So that is the clear investment where I would say XYLD is performing better than the NASDAQ overall. And so there's no doubt about it, it's outperforming NASDAQ. Gold over the last 1 year, as measured through the Spider Gold Trust, ticker GLD, this is an ETF that allows investors to have exposure to the gold asset, is down 2.84%. So perhaps XYLD is keeping up or kind of slightly maybe outperforming that. roughly the same ballpark. So it's kind of breaking even with GLD over the last year. Now, worth mentioning, over the last year, Johnson & Johnson, my largest position, my favorite dividend stock, it is up 9.4%. So that is vastly outperforming everything here. And that just goes to show the value of dividend stocks during bear markets, during corrections, and also just the value of holding reasonably priced core quality dividend stocks. I'm still buying J&J. I think it's a value at these prices as is, even though it has gone up. Now, also worth mentioning right now, this isn't over the last year. This is just kind of a go forward measurement. But U.S. Treasuries right now are yielding in the 3% range for those investors who are willing to lock up money for extended durations of time. Like the 20-year Treasury bond, for example, is yielding over 3% now. And so at least capital is being preserved. It's probably not keeping up with long-term inflation, but at least it's not losing. $1 equals $1 when it matures, and there's some interest paid semi-annually on top of all of that. And so I covered a lot of data in the video today, and I want to synthesize just the key takeaways. I think the key takeaways are: one, bear markets, corrections are a great time to stress test a portfolio and to readjust a portfolio if during the bull market the investor may have gone in some directions that were a little riskier or might not make as much sense. I think the second key point in the video today is that at least over the last year, these covered call ETFs, in my humble opinion, they got a lot of hype during the bull market. During the bear market, so far, they're not proving to be what I think most of us thought they would be. And so I'm continuing to hold XYLD, but if a really good opportunity comes up in a core dividend stock, maybe I'll take that XYLD at that moment in time and invest it. That being said, I'm a long-term investor, so I just want to give this thing more time as well. And I kind of look at it as an experiment of sorts. And so I might just let XYLD sit for a few years here and just see what it does, so I can do another video on it in the future and just experiment with this thing at only 0.5% of my portfolio and understand how it performs. But I think that was takeaway number 2, is just that these covered call ETFs have really not lived up to the hype that I think most of us thought that they would live up to. Now, the third takeaway in the video today is that in markets where core dividend stocks, quality dividend stocks just seem way out of touch, and the mind starts to think, well, maybe it's time to go after some other ancillary positions. Usually what I've found now over the last, say, 5 years of time is that when I catch myself doing that, it's going to be a good time just to save cash for a market correction to invest in core dividend stocks. But I know the practice is much more difficult than the theory, so I always need to carve out a few dollars for just kind of fun investments and experimenting with different investments like XYLD. All right, everyone, that's the video today. Share in the comments below what you think about these covered call ETFs. And before I go today, in terms of a full disclosure, I am long XYLD, I am long Treasury bonds, I am long I bonds, I am also long Johnson & Johnson, ticker J&J, I'm long PepsiCo, ticker PEP, I am long Starbucks, ticker SBUX. I own those positions in my personal dividend stock portfolio. I am also long stablecoins as well. So far in the correction, the stablecoins that I own have proven themselves to be holding really strong, but we'll see this if the bear market continues and crypto winter is around the corner, those stablecoins could get really stress tested as well. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market, in the bond market, in the stablecoin market, in the ETF market, please consult your licensed investment advisor first. It's possible to lose money in financial investments, especially during a bear market, a market correction, as we have seen. And so I'm just sharing my journey here on YouTube for fun and entertainment. I'm thankful and appreciative of all of you here in the community supporting my videos and smashing the like button. And I will see you all in the comments below, and I will see you in the next dividend investing video.